How we doing? How we doing? This is Destination Denver, Colorado, and today inflation in Denver is the worst in America. We're here to talk about that and a lot more. This is your December housing market update, and we're starting right now. All right, this is Destination Denver, Colorado. I'm your host, Jim Everett, and listen, there are two things we try to accomplish here. One, we talk all things eating, living, breathing, experiencing the Denver Metro and Colorado Front Range. And as a licensed mortgage broker covering the entire state of Colorado and team with some of the state's most talented realtors, I'm helping people like you move here each and every day. So a link in the comments there if you'd like to connect, as well as my number and email here on the screen. Know that I'm always the person answering those phone calls, answering those texts, answering those emails. Now that we're done with that filled stuff, let's get to what we're really here for, and that is inflation in Denver is the worst in America. So transparently, this is not what I thought I would be leading this video with. The first week of every month, I lead with a housing market update. And, there's certainly some things to get into, which we will, but this inflation report came out. Both the Bureau of Labor and Statistics and then WalletHub did this survey in which they looked at 23 metro cities, and they found that month over month and year over year, Denver's combined score between, again, those two month over month, year over year, were higher than these other 22 metro cities. And they found, again, according to their research, that month over month inflation in Denver was up a full percentage point, which I have to admit is pretty wild to me. That is a big number for a single month. And year over year, about 3.1%. Now, if you look year over year, the number isn't as staggering. In fact, there are other cities that are higher. 3%, to be clear, is not great. The Federal Reserve tries to aim for 2% inflation. We have not had that, obviously, in multiple years. It was the month over month number. So before going into more detail on that, I would just emphasize that looking at this data, are the previous months being too kind? Was the number for inflation on the previous months lower than they should have been, which then gives this significant increase? Is the data perhaps this month, again, inaccurate, showing too high? I don't really think that you're gonna find a full percentage point increase. Having said that, it's still a problem. It's still a significant issue to see that Denver ranks above, in a bad way, cities, some of them very familiar to you, like Los Angeles, Chicago, Philadelphia, New York, New Jersey, that area, Minneapolis, Washington, D.C. So several of these cities right now, Denver being worse. So why? We got to cover a lot of material in a very short period of time. So why would this occur? Well, what happened overall is that Denver's most expensive areas, or the most expensive areas of anywhere to live, all seem to increase at once. So we know that Denver has an affordability issue, again, much like most of the country, when it comes to housing and rent. Rent in Denver has stabilized for the most part. It's actually come down, and home prices have as well, but the inflation that has already occurred to those has really drawn up. We're talking about housing being over 30% more expensive in areas of the Denver Metro since before the pandemic. Add to that increases in homeowners insurance, increases in Xcel Energy and their on-demand, whether it's peak hours or not, overall, the expense of that. You look at auto insurance premiums skyrocketing because of hail, because of auto theft, which has been a big problem in the Denver metro area. So your house insurance is more expensive, your auto insurance is more expensive, and your utilities, again, powering your house, are more expensive. And then the finishing touches on that is Denver is a high income, high spending city. So the more we spend, obviously, the more businesses realize they can charge. So you look at our services, our restaurants, which can be ridiculously expensive, our gyms, our salons, even our service industries, and when I say service industries, I don't just mean restaurants. I mean your plumbers, your electricians, your HVAC people. Their charges have been more expensive. So overall, you just have this mass amount of expenses that you may face on a day-to-day or week-by-week basis in Denver that have all increased at once, which is driving us again to be number one in a really bad way in concern to inflation in America. Now, like I said, we're going to talk housing market as well. And before we get into the Denver market, which we'll cover, let's talk about some of the more clickbait material that is out there. And listen, when I first saw this inflation report, I thought to myself, is this clickbait? Is this something that really isn't something we need to focus a lot of time on. But I mean, at the end of the day, when you see Denver has the highest rate of inflation, something you got to cover. Now, some things that are less so, and to some extent, some of these next three things that I'm going to cover might already be off your radar. But first, word of a 50-year mortgage getting tossed around. Now, roughly 72 hours after this idea was tossed out, the blowback coming from it really, I think, put it off the map. I don't think there's any chance in hell that this occurs, but just in case it does, let's talk about it, because from a consumer standpoint, you might hear us going from a 30-year mortgage to a 50-year mortgage. Well, hey, that should really lower my payment. The short answer is not very much, but it sure as heck is more expensive. So here's the thing. You add 20 more years to the loan. Again, does it lower your payment? Yes, it does a little bit. Does it really create more affordability? Not even a chance. So let's use an example. So the typical difference between the interest rate on a 15-year mortgage to a 30-year mortgage is about half a percentage point. Sometimes a lot higher than that, but let's conservatively say half a percentage point. So if we apply that same logic, if we say that the interest rate on a 50-year loan is a half a percentage point higher than on a 30-year loan, and we'll use this following example. Right now, interest rates on a 30-year loan sit around 6.25%. And if we're using a $500,000 loan, we're gonna have a monthly payment, principal and interest only, of about $3,078 on that loan for at 6.25%. So make that 50-year loan half a percentage point higher than that, 6.75. And your monthly payment, principal and interest, again, not taxes and interest, just principal and interest, is $2,913. That is a difference of only $165 per month for adding 20 years to your loan. Now, let's get to the really ugly part. You're going to pay a ton of interest on a 30-year mortgage. There's no way around it, especially at around 6%. If that loan never changes, you're going to pay about $608,000 in interest if you just make your monthly payments call it a day. If you extend from a 30-year to a 50-year loan in that same principle where you're just making the payment, calling it a day, you're not paying extra, nothing like that, you're going to pay nearly $1.25 million in interest. You are going to double, more than double, the amount of interest you are going to pay on that loan for a 50-year. That, in a nutshell, is why this idea went away about as quickly as it was introduced. Now, the second hype train to cover quickly is the portable mortgage. This idea that you have a great interest rate on your house, maybe it's 2.5%, 3%, whatever, and you want to move. You're just going to take that loan and you're going to move with that loan. That loan's going to go to your new house. And listen, again, this sounds like a very promising idea, especially if you're one of the people who have a big loan with a very low interest rate. It might be nice to be able to take that and move to a different house. And this portable loan idea does exist. It exists in Canada and England, where, let me be very clear, there are some really hefty fees for using it. And the interest rate on that loan is typically negotiated every 3 to 5 years. So the reason that you'll hear a lot about this, and the reason it will pretty much 99.99% certain not happen here, is because the 30-year fixed mortgage is the envy of the entire world. I mean, the idea that you can borrow money from a bank with a fixed interest rate for 30 years is absurd to most countries. It's one of the most powerful tools that we have. So this idea that, one, banks are going to allow you to take this loan and just move it to a different house, which is their collateral at the end of the day. This house I'm sitting in is the collateral on my loan, and I'm going to tell the bank, hey, I'm just going to switch that to a different location, to a different type of house, to a different value. Don't worry about it. So in order for this to work, you would need lenders, investors, and federal housing agencies to completely re-engineer how the mortgage system in this country works. Right now, investors, again, not to go down too many rabbit holes, investors buy mortgage-backed securities and they expect a certain yield on these securities based on the collateral. You're completely revamping that. And the math breaks the second you try to port a low rate into a higher priced home without eating massive losses somewhere in the system. Someone's got to lose, and odds are it's the bank. And listen, as much as I would love to say you and I are going to win next to the bank, that's not going to happen. It's like Vegas. Vegas is going to get their money first, and then hopefully we get a decent amount of a deal afterwards. So again, could these portable loans exist in some way, shape, or form? Really, if we want to mimic Canada and England, you would be looking at loans that have an adjustable term of 3 to 5 years where your rate is changing. There's going to be a lot of fees up front. It is certainly, in my humble opinion, not going to be beneficial to any consumer, at least based on the examples we have in England and Canada. It's certainly not better than a 30-year fixed. And then last but not least, the housing crash of 2026. Basically the run on to the crash 2025, or 2024, 2023, basically every year since 2009 or 10, or as we started to recoup. And every year there is a new star. There's a new person that's telling you this is what's coming, and they use these, examples of these small areas, and they try to expand that as though this is going to happen everywhere. And this year we're going to pick on Melody Wright, who is an analyst who has been on every YouTube channel you can find. I'm sure if you Google her name again, Melody Wright, you'll find her pretty quickly. Who knows? Maybe she'll watch this video and argue with me. So Melody is pointing out how there are these areas where there's too much housing. That's almost hilarious. She likes to point out the fact that there are some delinquent FHA loans. FHA loans, just for you and I, cover about 1 in every 10 mortgages created. And she believes that a small portion of those that are potentially going to go into default are going to create this massive housing crash. She also believes that investors own just massive, and we're talking large scale investors, own massive amounts of real estate, and that they're just going to start offloading them in a hurry at horrific prices to crash the market. Again, that doesn't make a whole lot of sense. And then my perhaps personal favorite is that everybody bought an Airbnb as a second or third home, and they didn't put any money down. And when their Airbnb business crashes, they too are going to crash the market. Now, there are specific examples in certain areas, especially high vacation dense areas, where you're seeing home prices drop. And a lot of this was caused by the pandemic. And a lot of her examples are accurate in that way. But much like many of her housing crash colleagues, they focus on the micro, and they can't really explain how that would impact the macro. Her latest example on Twitter just this morning stated how 85,000 homes in the month of September nationwide had been taken off the market because people couldn't sell them for what they wanted to sell. Now, for a housing crash to occur, you wouldn't need 85,000 homes to be taken off the market. That's the opposite of distress. You would need people to start dropping prices massively on those 85,000 houses. The fact that people can take them off the market to either keep living in them, rent them, or sell them later is a sign of strength in the housing market, not distress. But you keep doing that good work, Melody. All right, so now that we got the nation covered, let's talk quickly about Denver and some key information here. And again, if you're expecting crash, keep holding out. If you're looking for prices of 2019, sorry, that's over. But still not necessarily bad news, because I think Denver is gradually, slowly moving in a good direction. So when I say that, the first thing I would mention is the median home price in October of 2025, that's the most recent information we have, shows the median price again at $595,000. That is overall for a home in Denver. Last year, this time, it was also $595,000, which to me is a good sign. I know we always talk about how housing appreciates year over year. I am of the belief that housing prices, and especially as long as mortgage rates, stay high, are going to remain level. I think this is a good thing. It allows prices to stabilize and for incomes to gradually catch up. It's going to take years. It's not months, but we are hopefully on our way. Now, the attached market, condos, townhomes, this is a little bit different. This is a very different story. The median price sits around $390,000. That's down 6% year over year. And that's really where you're seeing softening. I mean, the condo market, even going back to the pandemic when nobody wanted to live downtown, the condo market's been a bit sketchy. And now, all these issues with HOAs and their fees, and just, whether they have reserves and their insurance requirements, will Fannie Mae and Freddie Mac, the big conventional lenders, lend on them? There's a lot of challenges in the condo market. So I would take the condo and townhome market kind of set it aside, as this is a place where there's holes, and we can talk about that. Again, not crash holes, but some serious challenges. The detached single-family housing market, steady as a rock. Now, the big story goes into inventory and the fact that, again, in October, we sat at around 14,000 homes in Denver, and that is a lot for what we are used to. It's, again, not a lot when you look, when you back out and you see over a long period of time how the housing market has been, but for the last handful of years, it is a lot. To put that in perspective, the 10-year average for October, again, the last 10-year average, sat at about 9,000 homes. Again, we're around 14,000 as of that last data report, 9,000 being the average. And I mean, during the height of the pandemic, you talk about, October of 2021, we had about 12 houses in the Denver metro area for sale. So when people give you percentages, when they say, oh, the inventory is up 5,000%, some ridiculous number, keep in mind, it's starting from a ridiculously low. We throw around the term historical a lot, but a ridiculous, historically low number. So it's easy. Always remember, going from 0 to 1 is a 100% increase. Doesn't make it a big number. So is this good? Well, we always use a term, months of inventory. And this idea, which you probably heard if you've watched any of these videos before, is the idea that if you don't have any new homes to market and they're selling at a certain pace, how many months can you go before you run out of houses? Denver sits around 2.8 to 3.7. I think we got over 4 months of inventory. And again, it's a random number that's mainly used within the industry to track these things. But this is a good sign. This is, again, when we talk about balance, we have not had a balanced market in years. We had the post-crash years where it was pretty buyer friendly, and then it rapidly became a seller's market for the next 10 plus years here in Denver. We're finally seeing a market where sellers don't have to give up everything, but buyers are certainly getting a lot of leverage in the negotiations for these houses. So this balance is as close as we have seen it in easily the last 15 to 20 years. So days on market is a key factor, and what does that mean? What it means is that stuff is sitting. That the average house that goes on the market sits for about 33 days. And people will still hear during the pandemic how houses sold in less than 24 hours, just not the case now. Sellers currently in Denver are getting roughly 98% of their list price. So just kind of think about that for a minute. On a $500,000 house, that means they're going under contract at about $496,000. That's not crash, right? That is a slight correction, and that is sellers working with buyers to get their homes sold. So interesting to see homes are staying on the market longer, and the fact that you're seeing those slight, and in some cases, large price cuts. So the cricket impact is the fact that closings are down. There's about 3,300 homes that closed in October. The 10-year average, again, is about 4,500, so significantly lower than what we were used to seeing. And why is that? We know it's because interest rates still sitting between 6 and 7% will limit how many people are going to transact, how many people are going to buy a house, and how many people are going to sell a house. And this is where, to the point I made about Melody earlier, this was kind of the giving up effect for some sellers. There was roughly 2,000 homes that expired in October, meaning they were pulled off the market, stopped working with the agent, what have you. That means sellers just decided, hey, I'm not going to get 2022 prices. I'm not going to get the price I want. I'm just going to keep this place. And again, I'm either going to keep living in it, figure that out, I'm going to rent it, or I'm going to sell it later on, get into 2026. So what does this mean for buyers and sellers? Again, very quickly, buyers, it means that you have as good as an opportunity as you're going to see over multiple decades. Again, does it make it an affordable time to buy cheap houses or any of those things? No, I didn't say it's a fantastic time to buy. I said it's simply the best over the last couple decades because of the leverage you have. Does it mean that you can go offer $400,000 on a $600,000 house? No. And you're going to hear the stories of it happening, and that's all well and good. If you want to be successful, a fair offer and a talented realtor, which I am not, will help you in that regard. But don't expect to get everything you want, but man, you have some pretty good options right now. And I'll tell everybody, stop waiting on the crash. I don't think the market's going to get away from you. I don't think you're going to see home prices skyrocket. I think you're going to have a pretty stable home price over the next 2 to 3 years. You can prepare. But if you are sitting back just waiting for prices to decrease by 20%, you're going to be waiting for a long time, and I don't know why you're watching videos about it, because you're in for a long wait. And then for sellers, just being realistic. You miss the peak. When it comes to selling, you miss the peak. You're not going to get the most money for your house. But odds are a lot of you who are thinking about selling your house are going to go and buy a house. So you are going to give some on your sale and you're going to make up for a lot of it on your buy side, which is exactly the opposite of what happened during the pandemic. A lot of people sold their house for a ton of money, but then they had to go and also overpay for the house they were going to buy. So you give in one area to get in the other. And I would emphasize, again, I don't sell houses. I'm not a real estate agent. I don't attempt to give real estate advice. But the need to have a talented person, one way or another, in your corner is as crucial as it has ever been. I've seen sellers in this market who have worked with agents or themselves who don't know what they're doing, and it's a pretty brutal experience to watch from afar. So just my 2 cents. Again, does not change my world if you work with a good agent or bad on the sale of your home, unless we're trying to buy you a house on the opposite side, then it will. But just my 2 cents. So if we can go into 2026 with a change of heart, let's try to stop using the word crash. If you want to use the word correction, if you want to say home prices are going to go down a bit and it's going to be a correction, all day. Crash, just show me where the data is, because it is nowhere to be found. And that dream of the 50% price decrease, let's be very clear. For a crash to occur, you need massive distress, you need layoffs, you need people losing their houses, you need people losing all their assets, losing their money, stock market crashing. You need a lot of bad things to happen. A lot of people kind of operate from this idea that they're in a bubble, like this, prices are going to come down, but somehow I'm still going to have my job, I'm still going to have all my down payment money, it's just going to be easy for me. Not exactly how it works. So in a way, asking or hoping for a crash is in ways cheering against ourselves and cheering against our fellow human beings. Not exactly how I operate. Not what I see happening. I do see, again, a steady leveling of home prices, especially in markets like Denver. We'll see how inflation treats us in the coming months, but listen to the folks in the know, not the folks who want to terrify you. Even though the folks who want to terrify you tend to be the one that get the most clicks, but I digress. In the meantime, inflation, worst in Denver, in America. We'll see how those reports trim out as we get into 2026. In the meantime, this has been your Denver housing market update for December. This is Destination Denver, Colorado. I'm your host, Jim Everett. Till I see you next time. Peace.